The stock market just recorded its first 3-month losing streak since the crash of 2020. But with markets going into correction territory right now, are we about to see a short squeeze? Or have we already seen the signs of it off the most traded zone from Wall Street over the last 18 months? Well, upward volume would suggest that things are starting to improve, but really the story could be behind a tax strategy, tax loss harvesting. What do the institutional traders tend to do at this time of year? Join us as we cover stocks, commodities, and cryptos together, along with some of the TLC stocks that are in focus. Well, welcome back everyone to The Daily Show, where we discuss markets around the world, including the macro lead indicators and hottest charts. Just before we get into today's market coverage around the world, I want to say a massive thank you to each and every one of you to get us to 150,000 subscribers. We just hit that amount the other day, and I want to do a little bit of a token of appreciation, including something we've never given away before, which is some sessions with myself that I look forward to very much doing with members of the community. All you've got to do to enter into winning potentially one of 4 prizes is to put in your name, email address, and click the button. Links in the description down below. And I've always got to say, you've got to be in it to win it. So what are you waiting for? Give it a shot. I hope to meet you soon. Let's talk about fear and greed index. We saw fear start to dissipate a little bit as the market started to rally, but really it's the end of October. I hope everyone had a good Halloween, and now we're into, of course, November starting off, which brings us into the end of usually the biggest tax loss harvesting section of the markets. Institutional clients tend to pull the trigger sometime around this area. Basically, we see them tax loss harvesting the most in October, and most private clients doing it at the calendar year in December. Now, this stuff's all over on our Twitter/X account, which is links in the description down below if you want to have a look at it. But here are the TLC stocks. So basically the stocks that tend to be, targeted during these periods of time based on what they're doing so far. These are stocks that are down more than 10% year to date that also have Bank of America buy ratings on them. Some interesting ones there, some big names. And as we mentioned, it's all over on our Twitter X account. So why is this important? Well, it comes back to what's happened since 1986 all the way till now, and how right have they been about getting turns during this period of time. Well, it looks like the average return for TLC stocks over this period has been relatively positive. You can see here the November to January run is 78% of the time positive, with some pretty decent returns, 5 to 6% on these stocks across the point. Relative November-January periods, including the S&P 500 over those periods, was only 3.82. So which one did better? Well, it turns out that it was the tax loss harvesting stocks. So you can kind of see that sometimes they get a little bit oversold as people are trying to get those losses locked in. Let's discuss bullish percent index. Did we see an improvement? The answer is quite simply yes. If you're new to the channel, well, firstly, subscribe, hit the alert button. But overall, I would say that this is an indicator that we like to use from the focus of 30s and 70s. At this stage, we're underneath 30, so it's technically an area where you would be looking for a turnaround in this indicator, and that usually marks potentially a very significant bottom for the market. Speaking of bottoms, we also showed this Bank of America bull bear indicator, a lot of Bank of America today, and this shows us that we are in an extreme bear zone. Now, historically, it's either been a little bit of a touch into these bear zones or a full-on capitulation. If this thing goes all the way to zero, well, I think we're pretty sure what's happening, and that is a super fearful capitulation zone, and it usually brings in a lot of buy opportunity. But of course, at that time, you'll never want to buy it because it will be terrifying. Let's talk about average median performance once we enter into correction phase. We've already discussed this. We're in this week right now. 66.7% of the time, we tend to be bullish by the end of the week. And then it kind of goes into a bit of a weird session for a little while, maybe up to a month. That would be November. And then we tend to go into a bit more bullishness. Of course, if we go all the way back from 1928, you'll see the stats here, which you can pause the video on if you're interested. Some other things that are happening. This is a good one shared by David Keller over on Twitter or X, if you want to follow him. And basically, I was on his show recently. It was really good to meet Dave again. And you can see here that he's doing the S&P 500 versus gold ratio, which has actually been in a bit of a range for a while now. And I think the thing is here, when you're in a range, it's one of those kind of periods where you go, well, is this a good level for me to potentially say the S&P 500 should outperform? well, you could always argue that there's mean reversion coming and that we could go back into the middle of the level. We'll be watching this indicator a little bit over the next coming weeks because it is interesting. What about euro versus yen, or just anything to do with the Bank of Japan at the moment? If you're not aware of it, check out JP10Y on your charts and make sure you're familiar with what's going on there. But we saw a new low forming from the euro yen standpoint, and this goes all the way back to the global financial crisis period. Some weird stuff going on with Bank of Japan, and of course the intervention there is absolutely extreme. Expect that to be a story, especially if we start blowing through the 1% JP10Y, which we will bring up should it occur. It's something that is always in the background on our minds. Commercial and industrial loan growth has finally gone negative for the first time. Obviously, there have been periods of this in the past, and it's something that we should be looking at. Of course, zero growth is not necessarily good. For the record, though, supposedly the S&P 500 was higher 4 out of 5 times 9 months later after a similar cycle, and small caps were up every single time. So there you go. This reading might look terrible on paper, but that is at least the history of what did occur. So will the S&P 500 come up and actually start to move bullish over the next couple of months? We've been talking about seasonality. We know that in pre-election years that August into September, possibly into October can be rough, but usually November starts to be more of a sideways and December starts to be really good. In similar periods where we've seen August, September, and October, 3 consecutive months down, that's 3 down, we've actually always seen bullishness in month November, 100% of the time, and the final 2 months of the year, 80% of the time. The only time it wasn't like that was 1957. It's only a little bit of stats, but something there that we can keep in mind. Here is what tends to happen in November. We usually get a lot of up, down, all around as we build base. And then by the end of the month, even in pre-election years, we do tend to see a bit of a takeoff in terms of rallies coming back into the market. So, of course, we're hyper aware of that. This stock over here, or this particular stat from Wayne, is one I always like to look at because I think it was a really good one. The final 2 days coupled by the first 2 of November. Now, historically, this has actually been the more bullish day. We just saw another bullish session. So we had a bullish session, number 1. We had a bullish session, number 2. We obviously usually see a really good bullish session, find out whether we get that one, and then another bullish session. So it usually is pretty strong with a 17-to-1 bull ratio over this period of time. So far, so good for that stat, which we first shared, of course, as soon as it was about to occur. So it's day 2 in at the moment. We're going into day 3. For investors and dollar cost averages, you've got to like the market right now in some ways just because it's back to that 17 PE. For anyone that doesn't know, forward PE usually sits on an average of 16.8. So we're basically at average pricing. Not expensive by a standard deviation, not necessarily cheap. Yield inversion, we're looking for it to uninvert. We're going to talk more about that should it occur, but I want to mention it. And of course, we'll get the new sentiment survey at the end of the week to see whether the bears are still pressing. I do remember comments in the descriptions down below. You guys were saying, why didn't you cover XLP yesterday? We'll look at it later on. But yes, average returns for XLP when we get so bad breadth, which we have recently, have been bullish. I thought I'd bring this up. We also had one of these reads for utilities, which has been doing quite well. And that was only a month ago or so, or 3 weeks ago, and since then it's totally bottomed off at this stage. Here are insiders buying XLP at this stage, and with insiders, let's go over to earnings. AMD's earnings, not too great, I guess. Not too bad either, but most of the focus is going to be on PayPal, Roku, Qualcomm, and obviously the big one, the biggest stock in the world, AAPL, releasing Thursday after the close. Do remember, earnings season is basically almost over in terms of the most important. This is how many stocks, or these are how many stocks that we tend to see actually report this week. And then we have quite a lot next week, and then it's really over. The vast majority are done. And it's more important to really recognize the risks that you're placing. You might think every stock's going to have similar risks. That's just not true. Plus minuses for things like PLTR this week are off the scale. Plus minus 14%. Shop as well, plus minus 12. So be on the lookout. Something like Apple, even plus minus 5. So that's going to move around markets should the results shock everybody. I will say, though, I bought the iPhone 15 or whatever it's called, and I will say I prefer it over the 14 quite a lot. It's not that I liken it to like a Porsche 911. It's not really a big change, but when you hold it and you feel it, you go, yeah, it's actually a little bit better. It's kind of like a refinement. Would I suggest it? Probably not. But anyway, it is better than the 14, again, in my opinion. Bitcoin pricing Bitcoin price after halvings and before halvings. This is the time that we usually look at markets. And of course, we know that we're seeing this increase. Now, technically, if you're a Bitcoin bull, you like what you're seeing and you're thinking there's more to come. 40K, maybe even 45K. These are discussion points that are realistic based on previous halving periods. I've shared over on our Twitter. You can go check that out each one of the years. And of course, if we are in a similar cycle, don't expect the same returns percentage-wise. But usually when we have a negative year and then we go into the year before the halving, the year of the halving, we get 1, 2, 3 years positivity, 1 year negativity. That's actually what's happened now pretty much since the start of time for crypto. So if you're not sure about that, then of course you can check that out over on our Twitter or X account. Let's also move over to managed money net positions for gold. We've been in a short squeeze. We first brought this to you the other day, and we talked about, of course, funds getting absolutely destroyed by going negative on gold. They're still getting squeezed in similar occurrences. We tend to see, pretty large moves, and it usually ends up being just under 30%. Let's talk about large trades, though. There were some massive leverage trades coming in right at the close, and I'm wondering whether this was, to go towards the bull end or whether this is just like selling this market immediately towards the sell. Here is one which is in the NASDAQ 100, a leveraged fund here. We saw 2 monster trades come through at the same price right at the close. It does tend to suggest that there's probably a buyer sitting around here. So pullbacks might be bet by some kind of buyer demand. We also saw late prints coming through for another one, which is the S&P 500 3X ETF. Now, we've seen them already stack this once. So are they buying? Are they doing some kind of position purchasing around this level? It's certainly possible, and we'll be looking very closely at the price action to try to figure that out. Onto the options market. Before we get into the charts, I wanted to kind of mention this. In general, there weren't too many things going on, but of course, the ProShares Bitcoin Strategy ETF, BITO, it's out, and everyone was trading this one. 1.227 versus puts 9,000. Yeah, it's happened. There it is. And you can see the massive amount of options going straight onto that one. In general, though, it was a very low options day. 52% calls, 48% puts, and only 33 million. So I'm not going to focus too much on the options at this stage. In terms of rotation, we saw REITs having the best session, gold having the worst. So gold actually fell off, GDX down 2.64. And yeah, there it is, XLRE improving. Interesting. Certainly something that we do want to see improve with the market. And this takes us to the 5-day average here, with gold actually showing a negative for the first time in a while after that massive run it put on. If we go have a look here, it was regional banks, utilities, a mixture, REITs, financials over the last 5 days. If we keep seeing financials, which we'll have a focus on later, and things like regional banks improving, that could tell us that we're possibly through the worst of the correction so far. Let's talk about monthly stocks or percentage of stocks above the 200-day average. That improved, good sign. Above the 50, let's take a look at it. Definite improvement off those lows. And above the 20, we're also seeing it spike back above the 30. A positive sign for markets. What about some of the other things though? Uninversion, not happening yet. 1.033. We'll have to wait for the Fed's comments. And of course, everyone will be discussing what's going on with Jerome Powell, what he has to say about the markets. Overall, up volume was decent. And I would say it shows us a little bit of some thrust here in the market, some improvement across the board in most stocks. But it really comes back to a lot of the lead indicators. Things like USD yen, mark out the new alert. That's going to show you something's going on with, of course, the Bank of Japan. So that's one I would have on the charts. Copper as well, mark out a new high, 3.70. That's going to show you improvement in the markets. Already copper is trying to hold this demand. They call it Dr. Copper. It often tells us a lot about the economy's health. If it starts to improve, again, a positive sign. Equal weight market was up, which is a positive thing. So, of course, we're looking for this to get through 137.78 to really show us improvement is coming. But the main ones are Dow Jones Transportation Average and, of course, home builders. So we saw the average improve. That's a nice little move up off the lows. And if we have a look at home builders, you can see this is a significant level for home builders. I want to see it go a little bit higher, maybe 72.50 or something would be a sweet deal for this. And it may actually mark the lows for home builders in what's been a pretty big sell-off so far, and certainly something to scare us. What about central bank support? Did they come in? No, not yet. We haven't seen central bankers push the injection button yet, but who knows with Jerome Powell? Weird things happen. Central bankers around the world, if something breaks, they always tend to come in. And we saw that recently with this uptick. We saw this massive injection, and that flowed through to a nice little rally, which again, we'll look at the stats around that very, very soon. Let's also discuss what's going on with the US dollar. Everybody wants to talk about it. If I had to guess right now, I'd say it's probably actually going towards the bull end, just based on the last 24 hours. This was actually not a bad little level to see buyers come back into it. I've already spoken about my neutrality here on the dollar. I can see bear case and bull case scenarios. My main problem is we could do this easily, which creates more of a distribution or Wyckoff top. And I'm going to claim it's still neutral, though if I was a bull right now, I'd probably hold my position through from a technical standpoint. And the reason why is quite simply the way it's swept this low, the way it's built so far, the trend overall does look bullish. If the dollar is able to get to a new high and close above, though, the significance of that level could be that we move really high, back to like a 110. So it's got a significant movement, maybe 3 points here to 4 points on the dollar moving forward. So we'll be watching that one closely. All right, well, let's talk gold. And first up, of course, gold. We remain pretty bullish on it over the medium long term. But the big thing here is, of course, we're seeing a little bit of sell-off. This is due to mostly that dollar index starting to improve, but also it kind of having a massive squeeze in it and everyone getting on board the hype train. So when we take down the smaller timeframes, I think it's important to note that up until this stage, we haven't actually had a lower low. That could be about to change as we get in closer to these levels. Some zones to watch, things like 1973 and obviously underneath this zone of 1954. Those two zones will be important. If we do end up getting a deeper pullback, then there could be some opportunity as well for gold bulls to get back involved in the market. At this stage, though, we are really focused on the dollar index for gold, more so than anything else. Of course, gold itself should be looking better. Over on gold stocks, they're having a nice little pullback. Got no real problems with this. We talked a little bit around that 2750 into this zone. I don't mind gold stocks coming back. They hit their first profit targets. We're obviously looking for this high to really show an explosion of gold stocks. But as they pull back, they kind of get into a zone that is pretty good from a technical standpoint. And that sits around that 27 to 2750 zone or area. Let's move over to oil. Oil continues to fall down, which we kind of expect. And it managed to close right on that level, but more importantly, it actually closed underneath any of the previous closures. It shows us that we may be going back to the most traded zone, which sits around 77.60, and our kind of hunches on oil getting a little bit hit is mostly correct. People that, of course, shorted up in this area, they'd be smiling right now if they're still holding those short contracts. We know there's supply here, so if the market do rebalance back up to 84, this is going to remain a bit of a short zone for the markets, and of course for main traders out there and position-based traders. Tesla saw finally an improvement. It did close above 200, which is kind of nice, and it doesn't really look like it's found like any particular significant pressure here. If you go really small time frames, like a 15-minute, you could certainly make an argument that pullbacks will be met by a bit of bull demand, and we could go to 208. You can see 208 being previous buy and also supply. And you can kind of make a case that there was a decent little trade maybe coming up, maybe around that 196 we might see defense. Higher timeframes, though, hard to call at this stage. The trend is still down on Tesla. Another one that's in focus will be AAPL. Obviously, Apple finding its 200, finding a whole bunch of really important levels for it. Overall, this is a tough one because, of course, earnings is going to take over. It won't be technical by the end of the week. We do have some alerts set. 174.75 is certainly a bullish zone for us moving forward. And, of course, 178 also a very bullish zone. Let's move to sectors now. Financials, right on the high. This is an improvement that could occur here in these markets, and I'm liking what we're seeing in financials. We've obviously got the supply, we've got the low point, we've got the fear, and we're coming back potentially to take those highs. And this is happening, after a pretty significant sell-off. I mean, you go and measure this and you have a look at what financials have sold. They've sold around 12%, which is pretty significant. We're back down to crisis period levels. And we've seen the first sign of improvement in quite some time, or quite a period of time. Again, everything right now seems to be in a descending channel. If you take a look at the financials, look at that low. It's the same thing as the stock market. Let's have a look at XLP now, which is, of course, Staples. Have they shown improvement? We've got some alerts here set at 68.44. And we're starting to see the signs of maybe some turnarounds here down in the lows. Again, another pretty brutal sell-off through the staples. They sold around 14.65%, which is unusual for a staple coming back down to 2020 prices. So what will happen next? Well, statistics would say that it's oversold on staples. We'll find out whether those insiders are correct, but it can take some time to play out. Let's go major indices now. First up, Russell 2000. Some signs of improvement. I'm going to show the futures now. And you can see that futures still a little bit lackluster. No breakouts of any of the key zones or areas we've spoken about. Unfortunately, we're still looking at much higher levels. You could argue that if we get through 1672, it's better. But I think the S&P 500 presents a much better overall, technical than the Russell at this stage. We never discount the Russell, but we can't be using it. It's just not showing clean levels. The Australian 100, we're looking for prices above 6,900. That continues. I think it's a good zone, but not really a great technical replication. And the German market actually putting in the high that we wanted. We got that alert the other day or last night, 14,820. So we managed to get through those highs, kind of signaling that we might have a little inverted head and shoulders here, that we're starting to see improvement. And if we get through that 15,000 barrier, the psychological barrier, we're really starting to see improvement for the German market. This is exactly where you'd like to see the German market improve. It came right down into these previous lows of 2023 in March and those previous highs, and it's bouncing or trying to bounce off those areas. Still not enough strength in the market yet, but that's why we look at the S&P 500. Q's back through the range, certainly showing improvement here on the tech stocks. You can see the improvement here, not quite through that 14,425 area, which is support, acting as resistance and some supply in here. So obviously a key level. Another thing that a lot of people are drawing, and I've seen quite a few people talking about this, is some kind of downward trend line with resistances all the way through here where sellers could come back into the market. Again, well, let's look at the S&P though. The S&P is showing us the most traded level, the best setup area that we've had in quite some time, coming back down to the average forward PE ratio. We also know that, of course, we're focused on that trend line behind the back. So if we go to the futures market, here are what's been happening on the futures, and it shows you a sign of recovery. This is a pretty strong kind of level for the markets, 4180. We spoke about that. A breakthrough is significant. There were some short kind of opportunities on the scalp right around that 4180. I think we got to 4177. Let me just quickly mark here. Yeah, 4177 saw a little sell-off. Then it rallied back through 4180, and now we look for a few different zones. Let's go back to the daily here, just get a bit of an idea. First up, mean reversion to the daily 20. That's the red squiggly line here. That's going to be a pretty big deal. We've also got this green line up here, which is going to probably be around the top. So what we've seen recently is we've had buys off the bottom of this descending channel here, and then we've seen sells over here. I think a lot of people probably recognizing this now. I tend to focus more on that supply, which sits around the price of 42.67. So I think bears will sit between 42.67 and the top of this range. We will look at this very, very closely. A breakout of this descending could be massive for swing traders looking towards that super long moving forward. But most traded zone starting to get a little bit more breadth, starting to get thrust, and also showing us small time frame kind of buy levels. What I'd really like to see here is actually a swing low, which takes out a lot of stop losses, and then we see a rally into that 42.50 zone, breach through that, which obviously we know is the supply, and then if we get through that descending channel, that's going to be a big deal. So watch out for those ones. What about the Bitcoin factory? How's it going? Well, it had a pretty good session. I mean, it's held up. That's the main thing. You can see here on the daily, it's just in a is it a distribution, is it an accumulation kind of area? And the one thing about this is it hasn't really shown us weakness yet. We haven't seen a lower low. We haven't seen any change of trend at this point on the more significant timeframes. Only Ethereum's really given us that, and even that hasn't really sold off aggressively. So at this stage, I would say we're looking more at a Wyckoff distribution or accumulation and the signs of that playing out. And of course, that may take, unfortunately, a few days for us to figure if we actually see any move at all. Do expect Jerome Powell and the Fed to probably be the mover, though, catalyst for the markets over the next 24 hours. And also expect some big moves because we know the FOMC statement, the press conference, the funds rate, these all tend to be, big volatile events that can push the market easy 1-2% in only a few minutes, if not hours. So it can happen very, very quickly on those charts. If we go down, we also have another big news event, which is going to be the non-farm payroll change. That's at the end of the week, 8:30 a.m. New York time. So basically what we're getting ready for here is a spike in volatility and some key bear zones that could be hit very, very quickly. But overall, a little bit of niceness by the market. I'd be looking for a trap over the next 24 hours based on more the press conference than anything else, where the market goes opposite way for a little bit and then either rallies through or goes up and then rallies down. Generally, when we see these types of announcements, we see the first move can be the false move, and that's something I want to remind a lot of us of. We've seen that a lot recently with these results. Also, a reminder, if you haven't subscribed, make sure to do so. And if you're interested in entering the competition, there's no harm in doing it. All you got to do, name, email. In less than 6 days, we'll be calling this one. Bye for now. Thanks so much for subscribing. Catch you, everybody.